Hello and welcome to Making Sense, an investor education program of the Burlington County Library. I'm Carol Glade, a financial educator, and thanks for joining me. Working hard and saving money is important today, but equally important is protecting your assets and the important things of value that we have. During this video, we'll explore how insurance works and how to make sound decisions about risk management. Everything in life has some risk, but by making smart choices and using insurance wisely, we can manage risk more effectively. Insurance is nothing more than risk protection, not a savings account that you draw from. By buying insurance, you are paying a company to share the risk with you. Insurance is a contract. You must pay to get the services. The insurance company agrees to do certain things based on the contract. If it's not in the contract, it's not covered. So read your insurance policy carefully. The best situation is that you never have to use your insurance coverage. When you use your insurance, it means that you have had a loss. Buying insurance of any type is an important financial decision. Certain types of insurance, such as liability coverage, is required if you drive a car. If you have a mortgage, the lender will usually require that you have adequate insurance to cover the amount you owe on your mortgage. The main reason to purchase insurance is to protect your finances and your assets. Essentially, it's good to insure what you can't afford to lose. Insurance is risk protection, and there are three basic types of risk. First is personal risk and what we lose as human beings. Property risks are possible damages to or loss of property, such as our home or our car. And liability risks are losses caused by behavior that is negligent or that involves injury or damage to someone else's property or person. Costs of insurance are determined by risk, and the risk we take is based on three things: choice, chance, and control. Choice is the level of risk we as individuals take and the items we want to protect. Chance is determined by the risks we face. For example, if we drive in a city, we will have more risk than if we drive on a rural road with little traffic. New drivers generally take more chances than older drivers because of inexperience, and chance is often based on statistics. Control means that we can do things to manage risk. Our personal behavior and lifestyle determine our insurance needs. Remember, when you purchase insurance, you are purchasing risk protection. You have a contract with the insurance company, and this contract is called a policy. The protection lasts only as long as you pay for the policy. If you miss payments, you no longer have insurance coverage. And insurance is not free. By asking someone to share the risk with you, we pay more for this protection. We must each decide how much protection we need. Therefore, insurance will not be the same for everyone. And remember, insurance is not a savings account. When we pay for insurance, we're purchasing risk protection for a specific period of time. For some people, it may seem like you pay and never get back. But remember, insurance is also not risk-free. If you are too big of a risk and file too many claims, the insurance company can decide not to offer you protection or increase your rates. And insurance is regulated in each state. But remember that insurance companies are businesses that must make a profit to stay in business. Understanding the basic words associated with insurance is important. Your insurance policy is the contract. A written policy will be sent to you by the insurance company, and the policy spells out what is and what is not covered, so be sure to read it carefully. Coverage is what the insurance will pay for. So coverage can include payment of losses due to fire, theft, injury, or storm, but may exclude some things too, such as damage due to floods, wars, or terrorism. The term is the length of time the contract is in place. Most insurance policies are sold on a yearly basis. However, you may pay monthly or quarterly. Premium refers to the amount you pay. So if you pay $100 a month, you say that your premium is $100. Most insurance policies require that the person who is insured pay a part of each claim. The deductible is the amount you'll pay before the insurance company pays. The higher the deductible, the lower the premium. By choosing a higher deductible amount, you are saying you will assume more risk and therefore end up paying less. If you have a situation of loss, you will file a claim or make a request and report to the insurance company. Claims can be accepted or denied based on coverage. Too many claims will make you a higher risk and may be cause of canceling your coverage. Insurance can be purchased to cover the risk on various things. Disability insurance helps to cover lost wages due to the inability to work. Life insurance provides for beneficiaries after a person dies. Automobile and motorcycle insurance may cover the vehicle, damage caused by an accident, and personal injury. Property insurance helps to protect your home if damaged by fire or theft, for example, and can provide coverage if someone is hurt at your home or apartment. Health insurance helps to pay for the cost of surgery, medical treatments, and medications. And long-term care insurance helps to cover expenses for assisted living care later in life. Essentially, insurance coverage helps protect the things we cannot afford to lose: our health, our ability to work, our home and property, our car, or our lives. There are many things that will impact the cost of your insurance coverage. First of all, the amount of risk you want to accept will determine the cost. By increasing your deductible, you will assume more risk and your premium will generally be lower. Your lifestyle and behavior will also impact cost. If you have a history of bad driving, for example, you will be considered a higher risk. Your insurance premiums will be higher than for someone who's a good driver. Where you live, the type of home you live in, how you maintain your home, how you pay your bills, and other behavior patterns will also impact your rate. Your past insurance experience will impact costs. So if you've made many claims to an insurance company, your rates will generally go up. And the price of items covered by insurance will also impact costs. A large home will cost more to fix and rebuild if there's a fire than a small home. A fancy sports car will generally cost more to fix than a used sedan. Statistics about your area and your age will also impact rates. As you get older, you're getting closer to death, so life insurance costs will generally increase as we get older. Insurance is a contract, and the insurer is sharing risk with policyholders. The more risk we take as individuals, the less risk the insurance company absorbs. This means that insurance company will charge less when consumers take more risk. One rule of thumb is to reduce the cost of insurance by increasing your deductible on your policy. The deductible is the amount you agree to pay before the insurance company pays. If you have a zero deductible, your premiums will be higher than if you have a $500 deductible. Generally, the higher the deductible, the lower the premium. So, in review, insurance is risk protection that we purchase to minimize the loss of major assets. When we purchase insurance, we're entering into a contract with the insurance company. The more risk we assume as consumers, the less risk the insurance company has to bear. Therefore, when we increase the deductible or the amount we pay before the insurance company pays, our insurance costs may be lowered. And personal behavior will impact the cost of insurance. Remember, it's all about choice, chance, and control. Learning about insurance and the types of coverage available is important to keeping your money safe and protecting your financial assets. Thanks for joining me today. More information on this and other money management topics is available through the Burlington County Library through the Making Sense website. Visit or contact the Burlington County Library for more information. This program was brought to you by the Burlington County Library with funding from the American Library Association and the FINRA Investor Education Foundation. Goodbye.